All right, stocks continue to march up higher, and to the point where, on one hand, we got some really good bullish patterns here. A lot of these market forecast studies kind of in line with each other. So I'm going to show you that, break that down. On the other hand, there's some red flags popping up, just in terms of not necessarily warning against an imminent decline that could happen like tomorrow, but definitely some red flags that would suggest our reward risk ratios are kind of getting a little out of whack right now. And signs that suggest they can start to get even smaller than that. So in other words, just kind of stay tuned and be prepared, because 0 to 23% drops can come out of nowhere, as I've told you before, and I'll show you that again here today. Some ramifications of that and what those red flags are. And then I'm also going to show you, how do we trade when you want to be bullish, when you've got bullish stocks and bullish patterns, but you have to be prepared for the potential of continuing to go up for indefinitely, but also this out of nowhere noise drop because we've been so bullish. How do we do both and still be able to trade? So let's go. I'll show you how to do that with today's trade idea. So let's go ahead and get started. Today is Wednesday, August the 5th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, let's go ahead and start off taking a look at the S&P 500 with the market forecast indicator here. As you can see, we remain in this strong bullish posture here with the intermediate line easily in the reversal zone above the market sentiment. A little bit of a falling market sentiment line because we really haven't been, we rallied up so strongly here. We dropped pretty strongly, and then we went sideways for so long. And we're just kind of grinding here. So that grind is reflected in the market sentiment line that doesn't have enough strength here to keep it going up. We've seen that in the past, and usually that leads to weakness eventually in the intermediate line rolling over. Just not quite yet, because you notice the near-term line is also very high and very strong, which is also a very positive development. The cluster is a red flag. This late in an intermediate run, we're just a few days away from being 4 months complete, going into our 5th month of this intermediate run. So that's a very mature. The typical intermediate run lasts 1 to 3 months, so we're almost done with 4. So when you get them this late in the process, that you can get multiples this late in the process, so keep an eye out for more. But they tend to be red flags, signs of weakness. We're just not necessarily there yet, obviously, as the near-term line is very strongly bullish, the blue line, the intermediate line. In fact, if you look at all the indexes, look at the Dow, see how the Dow is flirting finally with getting above the 78% retracement level. Very positive sign for the Dow. Its intermediate line is finally crossed above its market sentiment, which is also falling, but you got a very strong near-term development. That's a good sign. NASDAQ 100, of course, its intermediate line finally crossed above market sentiment here, after being below it for a while, so a bit of a breakout there with strong short-term sentiment. And then the Russell 2000 also started flirting with breaking above that 78% retracement level of the decline, also showing strong intermediate posture above a falling market sentiment line with a strong near-term line. So, it's not too often that these indexes all have very similar patterns. And when we get very mature in our bullishness, they start to deviate, as we've seen. We've seen multiple deviations. The Russell especially has been such a laggard. It got dark pink shading. The intermediate line actually fell below 50, even if we didn't really get more than just a day of a red line there. But we are getting up to new highs again, so that's a positive sign for the Russell. So I can activate this and move this up to today's high, which is just a smidgen up above the 78% level. So if we can break up above there, then that puts the 100% line into play as a possible potential. And we've talked about that. The NASDAQ's already blown through its 100% line, but the S&P is just getting gradually closer and closer to getting up there itself to these old highs, now about 70 points away. And we're just getting small ranges day by day to be able to bring that ATR down. So we're not going to get there anytime soon. on the S&P. But again, it kind of shows the breadth of this rally now. Now it's not just all the Nasdaq 100. The Nasdaq 100 is actually slowing down a little bit after a brief, a couple of days of strong. They got this near-term line, but the near-term line's up on all of these indexes. The intermediate posture is above 80 now, with the Dow crossing above 80 here. The intermediate line's above 80 on all 4 of these indexes. The intermediate line's above the market sentiment line now on all 4 of the indexes. So very, very strong, and I'm not getting any kind of extreme near-term lows. The Nasdaq gave us this intermediate confirmation signal, but the near-term, the momentum line, has not been dropped into extreme lows. So very strong bullish patterns on all the indexes, which has been very rare to have them all in alignment, which just again continues to show the strength that we have and the potential we have for all of them to follow the Nasdaq's lead in getting back up to these 100% levels before we ultimately get the exhale that's widely anticipated, at least widely hoped for, because the longer we go without one, the bigger the exhale eventually will be once we get one. And nobody wants to go through that kind of decline again, and nobody wants to go through, even this kind of decline, which came after a long intermediate rally. Not so long on the Russell because we had that little dip in between, but the S&P, that was a 5-month-long intermediate rally, and that was the pullback that we had. Nobody wants to go through that, and nobody even wants to go through this one that we had in the fourth quarter of 2018, much less what we had earlier this year. So that's the problem, though, is the longer we go up without one, the more likely we are to get, just simply because the gaps between 0 and 23 and the gap between 0 and 38, which is actual pullback level, just keeps getting bigger and bigger the more we go up, which means the drop down to that line just gets bigger and bigger as well. So it's going to be uncomfortable, but I still don't think necessarily that we'll get there until, especially on the S&P, we get closer to these old highs, if not just a little bit through there, before we run out of buyers, so to speak, and it makes it easier for the catalysts to produce sellers and cause more weakness there. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us there on YouTube. That will notify you when our videos are posted. Also, while you're down there, hit the thumbs up icon. That tells us 2 things. You liked our video and you want us to do another video again tomorrow. Quick way to give us feedback. If you like our videos and you want to let us know, you can do it with 1 click right now, while you're watching. If you don't like our videos, of course, you don't have to click on anything. But we do appreciate that you're watching. Also, too, comment while you're down there on anything, questions or comments you have about anything I discussed in the video tonight. Post those down below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content. There's my handle up there at DavidSettle42. Actually, I think it might be up there. Regardless, DavidSettle42. Follow me there for more content. And also join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our website, we also invite you to check out the Market Outlook live video. Every day I do the Market Outlooks. I also do a live video on YouTube at 3:30 Eastern Time. Here's the link that will take you there. Click on that link to watch me go through all of our old trade ideas that we're still in. We manage all of our old trade until we close them. We talk about when and how and all of that. And then we put on today's trade idea before the market closes here. So again, that's available for all of our subscribers, both our monthly and our premium subscribers. Our monthly subscribers also get access to all of our trading rooms, except for 2 classes. So there's 8 trading rooms that we do every week. And then there's 2 Q&A sessions. Brandon does one and I do another. The Q&A sessions are available for our premium subscribers. Everything else is available. All of our trading rooms are available for our monthly subscribers. Of course, our premium subscribers get access to those 2, as well as access to our tools and community and charting and everything else that comes along with that. In fact, most of our subscribers are premium subscribers. We also invite you to click this heart that opens up a new window. Hit that like button right there. Click on this thumbs up. It takes you to your Facebook page. Where we invite you to click that like button right there. Again, the more you do that, the more likes these posts have, the more Twitter and Facebook will promote our content to all of our followers, even if you're not logged in at the time we post these. Also, it benefits you because they will promote content in your timelines from the accounts that you engage with the most. So we invite you to engage with us and try to make it really easy for you to do that here. Also, I wanted to point out, when you're on any page on our site, at the top, this orange bar here, you can see there's that blue button. Click on that blue button. That will take you to a page where you can subscribe to our site for free and get access to all of the free things. And when you click on the word pricing, you can see what we offer for our free subscribers, our monthly subscribers, as well as our premium subscribers there. I also wanted to point out too, the good news that came out. I tweeted this out earlier tonight. We use the Thinkorswim platform in all of our trading rooms, and it looks like Schwab is going to keep the Thinkorswim platform after post-acquisition, which I believe is supposed to go down here September 1st. So that will be a good sign, a good news for all of us that use what's a really, really good platform there. And they definitely don't pay me to say that. In fact, I used to work for TD Ameritrade. Some of you might not know that watch these videos. I used to actually work for their education department, my partner and I, and so we've been using Thinkorswim for years. They for some odd reason they're not the biggest fans of Market Scholars, but we are still fans of their platform. And so whether they like us or not, we'll continue to use their platform and promote it. Because we think it's a really good thing, and maybe someday they'll come around to where we'll be on their good side again one of these days. All right, let's go back and take a look at the weekly charts here. You'll see this great monthly is a great weekly candle. I mean, it's again closing above the prior week's highs. I mean, it's as bullish as you can possibly get. Not so much on the Dow, but better, right? Again, we're just barely getting above the 78, and we did get a higher high than these two highs, but we've still got some room to go there. The NASDAQ looks really bullish, very, very bullish candle there, coming off of a few transition candles, and of course the Russell is giving us a golden crossover, so that's a positive development. We haven't had that. The Dow has just barely given us one a couple weeks ago. And the S&P, has been about 6 or 8 weeks. So, and the NASDAQ has been going on this run now. From this transition candle right there, we've since had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15, 16, 17, 18 weeks of this run. And that's pretty bullish. And we are, well off of the 200-day moving average. If I were to take a look here and pull up how far up above this 40-week exponential moving average, which is what we use as our proxy for the 200. If I were to go back, as far as I can, just in the last 15 years, so that would include the Great Recession and coming off of that, you can kind of, let me put this chart here on a log scale. So that we can see it a little bit better. All right, so there's our Great Recession. That looks a lot greater. And then there's the move in NASDAQ 100 stock cents, so a nice good rally. And again, you can see we are 20% off of currently 20% off of the 200-day moving average. And the highest that we had been previously, if you look at my horizontal line, has been around 15% plus or minus percent or two, and we're up to 20%. Now, that's not the highest. When you go all the way back to where you possibly can, then here in the 1999-2000, we were 40% off of the 200-day moving average. Now, again, it wasn't 18 weeks, though. I mean, this was 1, 2, 3, 4, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 weeks, and then we had some bearish weeks to the 50-day moving average. Now over here, we had 1, 2, 3, 4. This was the end of 99 going into the beginning of 2000, where the NASDAQ ultimately peaked. 1, 2, 3, again after the transition candle there. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, some transitions there, 16, 17, 18, 19, 20, and then about 3 transitions there after 20 weeks of good bullish candles, and then we came back down to the 200-day moving average. So, that was quite the rally at that point, but at that point we were 40% above the 200-day moving average, well up above where we're at right now. This is where we're at right now to kind of give you an idea of my horizontal line. That's that, and this is high, very high. In fact, we haven't been this high since 1999, early 2000. So it kind of goes to show that we have been more bullish than this before. We have been more bullish than this before, but not very often, and especially not since 1999. It's been even just going 20 years. And you just go back from coming off of the 2000 recession, 2001, 2002 recession. Even over here, we were around 17% high. So it kind of gives you an idea of that's about as bullish as we got coming off of a recession low point. And then we were this bullish coming off of another recession low point. And then we were this bullish here at the beginning of 2018, where this bear market started, first quarter 2018, that we've been in, that we don't know about because the Nasdaq's been so strong, which has helped fuel risk appetite, at least in U.S. equities, at least in U.S. large cap equities. And then, of course, you can see how bullish we are now. So it's just that, it doesn't mean we can't keep going up. Who knows? We can go up another week or 2 or 3 or 4 or whatever. But it does mean that the reward, our risk for the reward that we would get on anything new from today going forward, we just have to take with a big grain of salt, because there's not a whole lot of room left to go here. We're very, very, very strongly bullish. Let's take a look at the 3 green arrow chart. And you'll notice, back to 3 green arrows, obviously, and if you look at the 2-line versions for these, the MACD and stochastics are both above the rising moving averages, and we're above the rising 8-day moving average, and we never did break the 17-day since coming off of this low point, post the June 8th high point. And we broke the 17-day, we went back above it, we stayed above it for a while, we broke it, and then it took a few days before getting back above it, and then we've been above it ever since. So we broke the 8-day a few times on an intraday basis, and then even on a closing basis, only to go right back above it. And that continues to be the case, and they're all rising, and everything's rising. 8, 17-day, 30-day simple, MACD, it's moving average, stochastics, it's moving average, everything's rising. And the stochastics is in the upper reversal zone, which means buyers are well in control here. It doesn't necessarily mean that we have to go up huge, but it does mean that even if we just go up a little bit and just grind like we have been, that the likelihood of us dropping huge, it's until we start seeing some kind of divergences or things like that show up, with how bullish things are. I'm not expecting a big downside. There's not a big, huge risk, that we would tank or fall off a cliff anytime soon. Though we do have to be aware, as I've told you before, we can go from 0% down to the 23% line on the S&P in a couple of days. That's all. It doesn't take very long. We can drop very sharply, and if we did get to the 23% line, we'd be back below the 78%. We'd be well below the 30-day moving average, and for that matter, we would also be below. Here's the 23% line. We would also be below the 200-day moving average, depending upon where we close and how long it took us to do that, or when that drop would start. Volatility would most likely ramp up if we were to do that, and you can see volatility is extremely low right now. One of the lowest closes we've had in a very, very long time. And the ranges are getting smaller. Yesterday's range on the VIX was 1.84 points, coming off of a almost 4-point range. We're down to less than 2, and then today's range was less than 1. So the ranges are starting to get really small, and that's a sign that we just kind of, it's not extreme yet to the downside, but we do want to watch the volatility compression for signs that volatility might jump from these really small ranges that it's doing, especially if you combine it with being being down to that 80% mark. See, now we've dropped back down below 10% on the 3-day. So if we continue to grind and this continues to get really low, see, last time we were this low was in June, and we had that kind of at the end of the month there, after June 8th, we spiked up to 40. We got all the way up to 44 from a low point of 23.5. Well, we're below 23 now. The difference between now and then, back on middle of June, is if you look there, here was the middle of June, right? Excuse me, it'd be right all the way over there. So I got to go back a little bit further. So here was the middle of June right there. So we weren't anywhere close to the 80% line there. So this time, not only are we getting some volatility compression that led to a jump that just came out of nowhere, and that was actually a drop to the 23% line as well. But that 23% drop only got you to the 30-day moving average. Remember, the next one will get you well below the 30, below the 50, below the 200, as well as the beginning of an intermediate run. So, and now you combine that fact with the VIX being way low on a relative basis here, then the next pop is gonna, again, can come out of nowhere on any move we get from 0 to 23% retracement on the S&P, and it could be a lot different, right? That would probably be our intermediate pullback at that point, because of how much we would expect volatility to jump up. If it jumped back up to the mid 40s, that would be a significant rally from significant lows that we're getting right now. If you look at the VIX 3M, which is what this is measuring, it's, remember, we're at 23 on the VIX. The VIX 3M, there we go, is at 28.5, right? So it's not nearly as low. In fact, it's not as low. We are lower than this low on the VIX. We're not yet on VXV, and if we were to get back up to the mid 40s, then you can see how if we did that here on this too, then we'd be at least up to 100% on the VIX if it made that spike, which is kind of what I would expect if on any kind of intermediate pullback. Let's take a look at today's volume and ranges. You see, let's go to this one. You see the volume again, 42 million, just very light. The range, 1.21 points. A little bit of a gap, so 330.06 was yesterday's close. Today's low, 331.18, so another point of a gap that you'd add to that. So, but still well below that average. Remember, one ATR, or 1%, that ATR at 1% would be 3.32 points. And so we are not quite there yet, but we're working our way down to that level, and we're getting very close. And we'll see if we end up using that level as a support initially, with maybe another run up to 1.5 or 2 before we finally settle back down. As you can see, another thing too is you have, compared to June 8th, our volume's a lot lower than we have right now. But if you look, kind of where we're at compared to where we've been in the past, again, volume has come back down to some levels that were where we were pretty strongly bullish back before. And we had volumes at this level back in 2017 with the S&P at 250 and the S&P's at 332. So a lot more money trading hands now than what we had over here. So that's also an idea, something to kind of keep an eye on that can lead to a pop in volatility here. So there's red flags and there's storms. Nothing imminent, like we don't expect it tomorrow, but it does tell us, okay, if we're going to be making some bullish trades that go along with this trend, we need to be aware of that potential and incorporate that into our risk management, especially when we get to the position sizing portion of any of our, especially our directionally bullish trades. All right, before we get to the second portion of our slide, I just want to summarize our technical outlook. Very strongly bullish, strong trends, some red flags, the oversold, the overbought cluster, how volatility is behaving right now. There are some red flags that are on the horizon, But nothing imminent, right? Nothing that we are like, oh no, like we better start selling off all of our trades right now. But we do need to be aware of it. And so, we don't want to go willy-nilly in any kind of bullish trades here without being aware of what our risk-reward potential is. And right now, there's not a lot of reward to risk ratio because of the risk. Even though it seems like the risk is very negligible because stocks go up every day. And the reality is, the more we go up without an exhale, the bigger the exhale will eventually be, which means our reward to risk ratios get very out. When we're 4 months into an intermediate run, they get very out of whack. So just be aware of those and trade smaller if you do decide to do any directional bullish trades and whatever trades there may be. You'll see today later. Obviously you've got a lot of, with options, you got a lot of possibilities besides just buying call options. So what do you think? Do you agree with that assessment? Do you disagree? Comment down below in the comment section, especially if you disagree. Let me know what chart or indicator you're looking at that suggests why you are either a lot more bullish than I am or a lot more bearish than I am right now. All right, let's dive into now what's driving this, and it continues to be weakness in the U.S. dollar. The dollar just is grinding up. Its intermediate line is well above. This is against the euro, mind you. Its intermediate line is well above the market sentiment line. Near-term line is bouncing back up from a bullish near-term low point. That's on the daily chart I mentioned before. The weekly chart is just getting started. So now we might not continue at this pace before, but we've seen this in 2017. Now it took most of the year too, but we're just kind of getting started here on the strength in the euro, the weakness in the dollar. This is the monthly candle I showed you as well. Its intermediate line just barely getting above. This is starting a new month on this just this week, but it kind of goes to show, this currency has been very oversold, and the same thing as well for other issues with the pound U.S. dollar. It's been down for so long, brief little runs here or there, but nothing to start a trend that we haven't seen, in a very, very long time. Right, pretty much since 2000 all the way up to the stock market peak in 2007 was the last major long-term run, and that's the type of move that we might be headed on here. That's not the case for all currencies. The dollar against the Swiss franc is, this is again a monthly chart. Is at a pretty, it's giving us a bearish pattern, but not from a high point. It's actually already pretty low. So the franc has been able to hold its value better. And then you look at it against the Canadian dollar, and you can see it still hasn't formed a dark pink shading or a red line, but you see its intermediate line is close to crossing. And you got short-term sentiment really bearish for this new month that we have. So not anywhere close. And that goes to show too, I wanted to show this as well. I wanted to show how gold is performing relative to bonds, in particular this intermediate term bond. Again, these are two very safe haven trades. So when gold is going up versus bonds, it can do that for a couple of reasons. It can do that during really bullish periods where the dollar is falling, or it can do that during bearish periods too, where it's kind of safety, the beginning of bearish periods. And right now, we're not rolling over. We haven't broken the 200-day moving average like we did in the beginning of 2008. So you would attribute this strength to just a weak U.S. dollar. And we haven't even really seen weakness in bonds yet, and that's why this ratio is still so low, because the weakness in bond prices and bond yields have not come up still. They're still very bearish. We're still strongly bearish on bond yields, and until we start to see more strength, we get a little bit here, but until we start to see more strength there, not only are we not really seeing much of anything, but if you take a look at the ATR, and again you have to look at it on a relative basis, that's because these numbers are getting so low, but if you look at the ATR on a relative basis, we're not as low as we were over here when rates were really high, and the ATR was was a pretty decent amount of that that we see there. But now, we are kind of getting to a low point of this current stage that we're in. that very well could lead up to a spike in volatility. A spike in bond volatility, which would be bearish for actual long-term bonds like TLT, where you can see, its ATR is very, very low, pre-COVID levels, and on a relative basis is below 1%. Very, very low levels of volatility. You can see we've been lower before, we've been strongly bullish, but these are really low levels. To kind of give you an idea, there's my cursor. 2017, we were pretty bullish, but you can also see now these. It's almost like we don't have any volatility right now in bonds, and that's what we're seeing here, and that could lead to, and not necessarily maybe this kind of jump, because a lot of that was kind of a bullish move, but during these rallies here, where volatility did ramp up and eventually got up to about 1.5%, 2015 into 2016, and then you can see even in 2011 we were getting up to about 2% and stayed up there as bonds got really bullish around the credit downgrade. So we'll see if we kind of get anything like that coming off of these really low bond volatility levels. Let's take a quick look at how sectors performed, and our weaker sectors actually had a really good day today. Our not so much energy, but especially industrials and materials and financials. If I were just to take a look at just today here, so give me 1 second to pull this up. So August the 5th. So if you look at just how they performed today, I mean, they started off strong. Energy started off strong too, and didn't end up doing as well by the end of the day. But financials, materials, industrials, all dollar sensitive areas, all weaker performers, all rallying today. Again, in June 8th, that they were the ones that rallied up to that till we got to kind of an exhaustion point, and then we got that 0 to 23% retracement pretty sharply, pretty quickly, and the VIX jumped up to 44, as I showed you before. So we're kind of starting to see some signs of that here with these areas: industrials, materials, financials, leading the way higher, and for the week so far, all the way through Monday. From Monday through, you can see, this rally has kind of helped push industrials and materials up, even if technology hasn't been strong today, but has been for most of the week because it started off the week so strongly. But look at energy making a really nice little move higher from very oversold levels, and then look at your safe havens, not only lagging but dropping, which sign of kind of maturing risk appetite here when you see something like that kind of discrepancy. So as we get more mature in this trend, you do want to kind of get more neutral, but still be able to make some money, and that's where our trade idea of the day comes from today. It's actually kind of a post-earnings trade instead of a pre-earnings trade. It's a trade on Disney where it had a nice little breakout pattern here to the upside. The market forecast, intermediate line crossing above its market sentiment, getting strongly bullish with dark green shading and a green line. But here's the kicker. I mean, everything else is pretty bullish, right? You look at the 3 green arrows, on Disney, you got 3 green arrows today and a spike in volume, very good bullish pattern there. All these other oscillators, all very bullish. The RSI above 60, well above 200. You look at the DMI, very bullish there too, almost up to 40. The negative index way down below 20. The ADX is just barely getting going, so no trend there. You look at the Ichimoku cloud, and you can see no trend because we're just barely getting going, but we are back, from this 23% level. We're back up to the 0 and potentially rising back up here. But the kicker here is a couple of things. Number one, way outside of the upper Bollinger Band, which when we get this far up, the last time we had this kind of move last November, we just went sideways for a while. So can we do, especially when you have a lot of volume up above us, the value area top is right there. There's a lot of volume, a big volume resistance node below the value area, as well as right above it. So it's going to have a really hard time getting going to the upside. But it's also not going to have, if we do fall and start to fill in that gap a little bit here, we've got very strong support below us too. So strong support and strong resistance usually want us to do, which usually means that we want to do some kind of neutral trade, especially still being in the value area itself and being at least in the upper half of it. So of course our neutral trade that we do in options is to do an iron condor spread. So we'll look at selling the 120, buying the 115, and selling the 135 and buying the 140. That puts us up here with the regular position size, because we are through earnings now, a little bit below normal, but pretty decent return. And then those break evens, you can see, are sitting at some very advantageous levels here. If you notice, the upper break even is sitting right on the value area, top of the value area, right on that volume node, with some strong volume below it acting as resistance. The other break even sitting right on the point of control. So as long as we kind of stay in the middle, and there's some risk by September expiration on either side, but you've got a lot of volume that can try to keep you on the right stuck here in the middle, especially according to the precedent, where we might go up a little bit, but then just kind of stay flat heading into, in this case, what would be the September expiration. Back then would have been the January expiration by the time we had kind of the breakout, or even into the December expiration, since the breakout occurred just barely before November. So we've seen precedent for this type of move, and we'll see if we can make money with that type of move again. Alright, so that does this for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That will take you to our Market Outlook forums. Open up any new thread there with any question or comments you have, or reply to anybody else's threads as well with any thoughts, and let's keep this conversation going here. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below, follow me on Twitter for more content between videos from day to day, and join our Market Outlook Facebook group we created, as well as our Market Scholars website, our community. Thank you very, very much for watching. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.